Today we have had a little bit of a recovery in the stock market after a pretty decent Friday bounce on the close. And I wanted to take a look today at something that's very interesting. I think you're going to like it. And it's going to compare this SP 500 decline with the one that happened in 2008 great financial crisis. I am your host, the Cowboy. This is Elliott Wave Cafe and Chart of the Day. Let's get started. So before we get started, guys, don't forget to check out my latest article here on the Pigeon and the Stallion newsletter, Bad May Be Good. Go ahead and give that a try. It is basically a recap of what happened last week, my thoughts on the markets, and what I think it's happening, and you just can kind of go through it. It's a 5-6 minute read. I think it's you're gonna get some interesting things out of this. So go ahead and check it out, subscribe, and share it around. Thank you. All right, so let's begin. I'm gonna get right on to it. Without a lot of introduction here. Basically we're looking at having a pretty decent correction from January high back here to, let's say, maybe Friday's low. And if you look at this correction here, it's about 20%, almost 21%, minus 20.94 peak to trough here. So I was analyzing this chart and this price action. I was trying to look at the prior corrections, and as I was studying this advance and how deep this correction can actually unfold, my mind went to the great financial crisis. It was right when I started trading. I started getting involved in the markets around 2007, in the spring of 2007. So I was through the grinder, quite early in my trading career here, and it was definitely an interesting time. I have lots of stories about that. So I wanted to pull the chart from that time, and here it is. We're looking back from 2007. This was when the market kind of hit a high about October 2007, and this whole this whole decline in the market lasted until, so it was 2007, and it lasted until March 2009. So about a year and about a year and a half of pretty let's say disastrous bearish type market, a very nasty decline in here where the markets dropped. I mean, this was probably, what was it, about a 50% drop, if not more, 57%. But if you notice, what I put on here is I put the decline, kind of how everything started, right? You've hit a high back there in October 2007, and then you started to sell off. And if you look at this line in here, this is basically another decline that's about 20%, 20.24% peak to trough there. So what the difference between this correction that happened in 2008 and the correction that just happens right now, I want you to notice kind of what's happening in there in terms of Elliott wave structure, in terms how the waves begin here, and why it's important to recognize how something starts. And based on that, you make your further analysis and how much can it go, and kind of what scenarios you have in the current correction. There is a difference in the Elliott wave corrective patterns if you're starting a decline in 5 waves or if you're starting a decline in 3 waves. Because the one that starts in 5 waves, it's much more dangerous overall than the one that starts in a 3 waves. So just by looking at this 20% decline in here, I'm noticing that this move from the highs to the lows there, that's about 20%. It's pretty much a 5-wave decline. So I can go in here and just say, that you have a wave 1, you have a wave 2, you have a wave 3, a wave 4, and a wave 5. So right there, you have a pretty nice, I would say, clean 5-wave decline. If you look in here, you have a 1, 2, 3, 4, and 5, so that's fine. You pull back in 2, then you have a 1, 2, 3, 4, and 5 for 3. You pull up in 4, and then you have another 5th wave. So what this does here, this sends you automatically into thinking, well, if this is a 5-wave decline, that means that we're going to get, either a B wave followed by a larger C wave, right? Either you're going to get a wave 1 and a wave 2. So what the market did here, if you notice, if it's done a decline here in a wave 1, and it wasn't a C wave, you could have thought possibly that this was a C wave, right? As the market was doing the decline back then, it was like, fine, it looks like an A, up in B and then down in C. But here's what happened. This move out of here never really made it anywhere, and instead it was very, very weak and it not do anything. So the moment this kind of happened and it broke below these levels, you probably thought, well, I think there is something going on here. You're going to have a wave A, you're going to have a B, and now you're going to get a C wave decline, and the market did a 1, 2, and then you'll be like, oh my goodness, this thing is going to go, 3, 4, and 5. And sure enough, instead of doing an ABC, it did something much larger, and this is what it happened. So if you go back and count, I think I've used the wrong, one here, but I'll come back. So let me use this back here. So then you go and you can see kind of what happened here. So you have another 1, 2, and then you have a 3, a 4, and a 5. So that's another large decline, right? And you might have been thinking, well, is this an ABC? Isn't this too long for it to be a C wave? And sure enough, that was the correct approach. And instead, you've gotten a wave 1, a wave 2. This whole thing was a large third, and then you got a fourth. And then you got a fifth, and the correction was over, and you moved higher. So if you look in here, it was a 1, 2, 3, 4, and 5. Let's see, just out of curiosity, how far that wave third traveled. 261.8. So that's a pretty massive extended third wave. That was the first clue that you're probably going to get a fourth and a fifth right there. So something that started impulsively actually created here a much larger problem for the development of discount and for obviously how bearish this market was. So it starts with an impulse, and instead of becoming an ABC, it becomes a 1, 2, 3, 4, and 5. But to assume that that could be a C wave, you kind of had to go back and take a look at the larger structure, which overall, and if I can find out how to go back to a larger time frame in here, you could look at this and it was part of a flat, because this whole thing was a decline in A, this was a B, and then this was C wave of a flat. So you basically had a bit of an expanded flat here in the C wave. So, this was your decline from 2008. Now, because you always kind of have to go back and take a look at the larger degree of trend and see how this impulse fits in the overall picture, and the best fit there was as a flat formation. So let me make this back smaller, and I'm going to go back to a 1-day chart, and I'm going to go back to 2008 right there, and we're going to take a look and comparing this to kind of what's happening into this decline. So this was a pretty heavy impulsive move, right? That started with a 5-wave decline. Now, what you have right now is you do not have a 5-wave decline. Let me put that back. What you have instead is you have a 3-wave setback so far. So however you scramble to take a look at this decline from this highs to this lows, based on being the same percentage decline at 20%, this is not an impulsive move to the downside. It's a 3-wave setback at the moment. It does not mean that it cannot become one later on, but so far with the 20% decline, it is not. It's just a 3-wave move here. So if that's the case, then, as I was talking before, how do you look for evidence? How can you kind of anticipate what's going to happen next and what the market will basically be able to do? Well, if it's a 3-wave decline only, and it cannot be a 4th wave based on the fact that this will become too large in here, is not going to be able to match it with anything prior, that means that it's got to be a 2nd wave. Well, if it's a 2nd wave, then how can this develop? It can be finished right here, and you can go, let's say in an ABC, and it could be done, or it could be, right, there is an ABC of a W, you're going to go up an X and then come back down. So the difference is that unless this sells off much lower, and it becomes something like this, right? Let's say that this is somewhat, and even this one is very hard to count it impulsively because you have a big swing in here, which almost tells you that that's, you know, that's some kind of a B wave in there. So you can have an ABC, you know, X, and then maybe another ABC forming, and it could be done. But let's just say that maybe I'm totally wrong, and this is actually a flat, and that's a 1. You know, this is a wave 2 in here, and this becomes a much larger third wave advance. Well, this has to kind of get going and starts to build to the downside, and you got to create this, and then you got to create that for this to become a 5-wave move. Well, if this happens and you look at the size of this decline, you know, this would be, just based on a visual, more of a, you know, standard approach here, you know, this would be almost a 31% decline. And what this would mean is that this is just wave A of a correction, and then you're going to get a B and a C, right? Because you cannot really fit this as a flat into anything. It's got to be the beginning of something else when you look at the prior moves back in here. So you see, that's the big difference. And that's why, you know, for this to decline in 5 waves, that would mean that you would have to have, you know, a much, much larger crash in the market that would need to last, you know, much longer, because you're going to get a B wave in here, and then you're going to get another leg lower, let's say something like that. Or if it really wants to be, right, it could be a 1, 2, 3, 4, and 5, and you basically crash back to 2200. Now, I don't know about you, but you know, a lot of the stocks have already, you know, crashed quite a lot. I mean, the earnings are pretty decent, so I don't see this as a high probability of, you know, of happening out, unless, you know, something horrible, let's say, happens on the globe, and who knows, you know. But this is why, you know, there is a big difference here between kind of what happened in 2008 and kind of how this correction started in 5 waves, and how this correction is starting, which is highly corrective. Now let's see how else can this unfold and still, you know, keep you bearish to the downside and say that this could still be, you know, a pretty impulsive move lower. So the way I would look, it would be maybe, right, something would have to be where this is, you know, that you would have to do, let's say, a Y1, a wave 2, then another 1, 2 in here, right, with a lot, but it's still the same thing. You still have to drop much lower in a big advance. Otherwise, you know, for it not to be impulsive, then you have to switch to some type of a corrective move where this is, let's say, a combination here, you know, or, you know, just like that. So you go, you know, in a W, X, and then let's say that this is still an impulse, and you go in an A, B, and then down in Y, something like that. So it means that you're going to get a B wave and then Y, and then this correction is kind of over. Like, because if you look at how much we pull back in terms of retracement from here, right? Let me get the log scale out of the way. So you pull about 38%. Right, you pull about 38% right now into this move. So for a second wave, it's still fairly short, you know. But if the market is strong, it can definitely be all it is, and then you can start to move to new all-time highs. If it really wants to pull back to 61%, which is about 3,200 in the S&P, right? That means that, you know, it's, under these circumstances, it's going to look very ugly. It's probably going to have to be something like that, where you go in a W like that, and then, you know, you go back in some type of an X-wave rally, you know, that's still supposed to come, right? And only then you sell off in another ABC, and this would look, I'm going to put a channel in here, analysis. Here is the channel, right? So it will look something like that it draws down back into the 618. Okay, so, but it's still not such a heavy sell-off as you've had it back in 2008. And here's the thing, back in here, I'm just going to go back to it. Come on. Here is what happened after a 20% decline, and just kind of keep that in mind, right? Here's what happened. You've had a rally there of about, let's see in here, almost 15% of a move. So how much would be, let's say, a 15% rally from here? So 15% would basically get you all the way up there, something like that, before, let's say, another decline begins. So if you were to compare, this move back in there with this move back in here, it would be the same thing, about a 15% rally, about a 15% rally. That would give you this X wave, and then you would get your decline to start, let's say, into this larger Y wave. That's why this level back here is very important, this 4640, because if you climb back above that level, right, you're going to be in, you're not going to be in a lower high territory, right? You're going to make here, a higher low. So that is important for this market to continue to push to the upside. So there's plenty of time here to kind of, digest that. First of all, you got to find a low. So to stay away from an impulsive move like this, right, this market will have to, to get an impulsive move like that, this market will have to crash about, I don't know, maybe another 20%, another maybe whatever, 15, 20% from current levels to get in a 1, 2, 3, 4, and 5, right? Just in a straight impulse. And that would tell you, listen, with just starting this, we're going to get a rally and then you're going to get another decline. But for right now, you sold off in about 20%. It appears to be a three-wave decline. You can get a 15% just like you've gotten in there, and then a push lower. So just I wanted to kind of draw a comparison in terms of kind of how the correction starts. So anytime, if there is anything to take from this video, is that anytime you start with the 5-wave impulse off the highs after you've hit, an important high, obviously at the time, you couldn't have say that that's that important. Maybe things were looking very rosy, and there was things underneath the surface with the real estate market and all of that, but that was the first signal that something is cooking underneath the market, and it gives you about a 15% chance to kind of get out of there after this impulse. That's why once you get 5-wave moves off the highs, and you're getting a second wave or a B wave pullback, that's the signal, to get out of there. And you kind of have to look at what the fib retracement is of this, and anywhere between 38.2 and 61.8, it's a decent pullback for the second wave and allows you to get out of the market. And the market gives you that chance, but then they don't, then they kind of, crash lower here aggressively. So, if there's something bad starting, I think we're towards the initial phase of this decline. We're probably going to get a little bit of a rally in here, and then, then we'll see what the market will say. We're going to crash. Maybe it's going to come in September, October, and you're going to get a much larger decline. Who knows what the news will be then? You're going to have elections, all kind of things can still happen, with Ukraine, with the global, trade and this, the geopolitical and economic things that drive, that drive funds across the globe. So, guys, I don't want to get a lot into this, but, I just wanted to show you a little bit of a perspective, how corrections start, what's the difference, analyze different markets, go back and look and see the percentage declines. Markets, tend to follow the same flows, and then, it kind of give you a better understanding by using the Elliott wave, like what's possible, what's likely to happen, in this structure. Don't forget, I still have another 7 days of, discount for my program there. If you guys want to come in and join, you can get 2 months for the price of one, on both the main pro channel where we talk core markets, and the Bitcoin channel where we talk only about Bitcoin and videos and charts about that as well. So both of those are available for another week there. Don't forget to subscribe and like always. I appreciate you being here, and I'll see you tomorrow. Bye-bye.